You got to be bullish on gold and gold miners. And again, I'm sure people aren't super surprised to hear me say that. I do have some other stocks out there that I think are worthwhile, but I love the price action in gold here. It's so close to the all-time high line up here, which again, going back to 2020, that was that high line right across. We actually are up again today, consolidating beautifully. I would guess within a month or so, we are breaking out to the upside on gold. Gold miners are so cheap down here if gold can break out. I say if because again, if it doesn't, then gold miners aren't going anywhere. But I love the price action on the GDX today, getting a good move again. Beautiful double bottom right down here.
Gold starts the new week strongly, building on last week's recovery trend as buyers propel the price higher. This upward momentum is partly due to a weakened US dollar, which in turn is tracking lower US Treasury bond yields amidst a mixed market sentiment. Considering their recent price movements, Gareth Soloway, chief market analyst, shares optimism regarding gold and gold mining stocks. The gold price remains above the $2,000 mark during the early Asian session on Monday. This stability is partly attributed to U.S. economic data hinting at persistent inflation rates, leading financial markets to moderate expectations about a potential interest rate cut by the Federal Reserve in June. The gold price is currently trading at $2,014, registering a 0.12% gain for the day. Gareth observes that gold's price is near its all-time high and appears to be consolidating well, suggesting a potential breakout shortly. However, he advises caution, emphasizing that gold miners may not experience significant gains if gold fails to break out. Notable mentions include Newmont Mining and Barrick Gold as robust options for investors. In the past quarter, average spot gold prices have surged by more than 13% due to a weakened dollar and optimism about potential interest rate cuts by the U.S. Federal Reserve this year. Barrick Gold's copper production has also significantly increased to 113 million pounds. Barrick Gold reported an adjusted profit of 27 cents per share for the 3 months ending December 31st, surpassing the average analyst's estimate of 21 cents, as per LSEG data. Additionally, in the third quarter of 2023, the number of hedge funds bullish on the stock rose to 36, up from 32 in the previous quarter. Join us as we delve into insights shared by Gareth Soloway. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
You got to be bullish on gold and gold miners. And again, I'm sure people aren't super surprised to hear me say that. I do have some other stocks out there that I think are worthwhile, but I love the price action in gold here. It's so close to the all-time high line up here, which again, going back to 2020, that was that high line right across. We actually are up again today, consolidating beautifully. I would guess within a month or so, we are breaking out to the upside on gold. Gold miners are so cheap down here if gold can break out. I say if because again, if it doesn't, then gold miners aren't going anywhere. But I love the price action on the GDX today, getting a good move again. Beautiful double bottom right down here. Newmont Mining, AEM, Barrick Gold are all interesting plays. I'm generally sticking with best of breed right now because I think those will be the first ones to be the recipients, and then the juniors might be next. A couple stocks that I think are worthwhile keeping an eye on. I think something like Hershey. Any sort of uptick in inflation makes the probabilities of the Federal Reserve cutting interest rates as much as the market is pricing in less and less likely. So if we look at just a few months ago, it was 6 rate cuts that the market was pricing in, even though Jerome Powell was saying, hey guys, we're not going to start cutting till the second half of the year and we're only going to do 3. I think if you look at the Fed funds futures tool, the watch tool, it's now down to 4 rate cuts this year. The first one starting in June now. So the markets are slowly adjusting to that reality. The interesting thing about it is the stock market's still pretty close to the all-time highs. We really haven't seen a pullback yet. And the kicker for this is simple, right? You have a market where everyone is starting to chase. This is exactly what we've seen going past to, like, you look at a scenario like what we saw in 2021, where there were a lot of bad signals out there of what was going to come in 2022, but money was just saying, I don't care about valuation. I don't care about technicals. I am just going to jump in, and it creates these bubbles. And a good example of the bubble, right? I mean, take a look at SMCI. This is one of the favorite out there of the meme crowd, right? If we look at this today, look at this. I mean, this run up was incredible, up and away. We're talking about from $300 at basically mid-January, so 1 month ago, And where are we as of this morning? We were trading at 1080 before a collapse back down. This is bubble territory. And by the way, I'll even go on record and say this is the same sort of thing. The atmosphere in the market is the same as when I called the top in Bitcoin at 69,000 in 2021. It is exactly the same psychological sentiment out there. I think if we started to see a really bad recession, then inflation does get down to the point where it could be deflationary. But if we go into kind of one of these stagnant markets
Okay.
where, for the most part, we're in a slight recession, it's kind of things are slow, things are kind of for a long period of time, where you're not really seeing a huge drawdown in the economy where it's a deep recession, then I think you have the pressures of increases in wages that still get passed through. And we've seen that, by the way. I think the PPI is showing us that, the CPI is showing us that producers, they're paying so much extra. You have people that were making a minimum wage that are now making 2 to 3 times that minimum wage. That has to be passed on to the consumer to keep the earnings flowing from a lot of these big companies. And so it's not a one-year event, right? I mean, if you pay someone $20 instead of $10 an hour, you can't really just double the prices that you're charging your consumers. But what you do is you say, okay, well, I'll raise it by 33% this year, 33% the next year, and the next year as well, to bring my profit margins back in alignment. So I think that's the kicker, is how bad is the recession and what do we see?
Inflation has been a topic of keen interest for many, and Gareth shares his perspective by comparing the current economic situation with that of the 1970s. They forecast that inflation could reach the 3% mark and then struggle to fall below that threshold. On Friday, the Labor Department released its Producer Price Index, which measures inflation before it impacts consumers. According to the report, prices rose by 0.3% from December to January, following a slight drop of -0.1% from November to December. Year over year, producer prices increased by a modest 0.9% in January. Gareth cautions that if inflation remains above 3% and starts to rise further, it could pose a challenge for the Federal Reserve. They would face difficulties aggressively cutting rates to boost the economy without potentially exacerbating inflationary pressures. Despite the challenges, Federal Reserve policymakers remained composed and saw the overall progress toward the Fed's 2% inflation target as positive. They also noted a slight moderation in labor market strength, but overall, the economy appears on track for a soft landing. Let's get back to the interview.
I do believe that we'll get down to that 3% handle, and then getting from 3 to 2 is always the toughest thing. And I continue to see the reminiscences of what happened in the 1970s. And in fact, I can show my chart right here and we can just kind of take a look at it. But basically what we see here is this was the 1970s, and you had that initial uptick, and then the Fed obviously kind of stepped aside, and inflation came down, and then we had another wave of inflation went higher. The same thing pulled back. We had another wave higher as well. And then finally it got back under control. And I really think that, as much as the Fed has said they don't want to repeat what Volcker did, if you look at the 10-year yield, right, the 10-year yield, the Fed funds rate's still at 5.25 to 5.5, yet interest rates on the 10-year are back to the 4-ish% level. In fact, we were below 4. So you've seen those interest rates come back down even without the Fed lowering rates. And what that does is it starts to initiate inflation again. It starts to kickstart that inflation because borrowing money is getting cheaper again. And I think you have to look at many things, right? So just a couple things I want to point out is that, you've seen the balance sheet of the Federal Reserve drop just a little bit. It was 9 trillion. It's down to 7.5 trillion. So the Fed has kind of started to contract that a little bit. But the kicker is, if you look at all these auto loans, credit card debt, U.S. public debt, they're all surging to the upside. And so that's making up tenfold the amount of the pullback in the balance sheet. And again, just to show you in comparison, this is the pullback here, right? This is where we were. We were trading around $9 trillion. They've only been able to reduce their balance sheet to about $7.5 trillion. And that's while the U.S. deficit has risen multiples of that over just the couple years, right? So again, my point being is that when it comes down to it, you're in a scenario where the Fed, they've tried to tighten, but the market has actually loosened. And then you talk about the extra money in the system, from credit card debt to auto loans to the U.S. deficit, and it really hasn't been that tight. And I think that's probably why the stock market is at all-time highs as well.
Okay, so the 70s was a major period in economic history. There was a huge spike in oil prices, as you know, from the OPEC oil crisis. It's going to take a lot to bring back that era in the sense that we're going to have a major supply crunch or some sort of major shock in the economy to bring
Right.
inflation up to those levels,
And
right? Yeah.
and to be fair, David, I don't think that's going to happen. Like I'm not
Okay.
anticipating inflation going to 10 and then to
Okay.
20%. But the kicker is this, right? Is that the Fed was banking on inflation getting to 3 and going below 3% so that
Mm,
they could stimulate and cut rates when the economy slows. If we're starting to even uptick from 3 to 4%, how does the Fed start to cut rates aggressively at that point, knowing the repercussions of cutting rates is to stimulate inflation again? And so I think that the more important thing here is just if you can't get the inflation rate in this period below 3%, and we start seeing an economy that's weakening, and by the way, Cisco laying off 4,000 people. I mean, we've seen layoffs starting to compound. We've seen the retail sales just came out a couple days ago, and those are starting to get weak.
Additionally, the price of gold is taking advantage of a sluggish performance in the US Treasury bond yields and geopolitical tensions in the Middle East. The latest developments include news of a Belize-flagged, UK-registered, and Lebanese-operated ship that was attacked in the Bab al-Mandab Strait, Red Sea. The gold market has been showing resilience amidst various market conditions and geopolitical developments, as discussed by Gareth Soloway. How do you perceive the current status and outlook for the gold market, especially concerning geopolitical tensions and the ongoing economic shifts? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.